Okay, good morning, everyone, and welcome to the first of three events actually we have happening here on Coffee Microcaps this week. Lots of companies obviously reported in the last month, and we're going to kick off with the first one this morning. We've actually got 10 companies presenting over the next 3 days. I'm just going to quickly run through some intro slides here, and then we're going to get straight into it with our presenter. My name is Mark Tobin. I'm the founder of Coffee Microcaps. For anybody joining us for the first time this morning, for any of our regular attendees, welcome back to this morning's event. I'd like to give a special mention to DMX Asset Management, who are our virtual event sponsor here at Coffee Microcaps. If you're looking for a small or microcap active fund manager, please do reach out to Stephen or Michael or check out their website for the relevant PDS and other documents. Just a quick announcement. We are getting back to live events after COVID, and we're going to have our first in-person event 27th of April in Sydney, and we're going to have our first ever Melbourne event, which is going to be happening on the 2nd of May. Tickets went on sale via Humanitics this morning, and they're $40 for anybody who wants to come along to one of our live events. Compliance and disclaimer slide. Company criteria for anybody joining us for the first time. We normally have companies capped under 300 million in revenue and approaching cash flow break even, or indeed already profitable. Generally don't have companies from the resources or biotech sector. So what I like to call industrial microcaps, which kind of covers all the other sectors: tech, retail, financial services. Structured this morning's webinar. We generally do these every fortnight. Each company gets a 30-minute slot broken down to roughly a 20-minute presentation and 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. Makes it easier for me to moderate to our presenters. And please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel at some stage tomorrow. You can follow us. We're generally on all the socials. Twitter is probably the best place. YouTube for the recording of this webinar, and indeed all the other webinars. Got over 100 presentations of ASX microcap companies up there now. LinkedIn, and I also write a free monthly newsletter that you can get on the Substack newsletter platform. I'm delighted to be welcoming back Chris Noone, CEO of Carly Holdings this morning. And with that, I am going to hand over to Chris. So Chris, I'm going to stop sharing my screen. And if you want to share your presentation, I'll let you know when I can see it up on screen here. Yeah, it's coming through now. Yeah, I can see the cover slide of the deck now. Chris, you can take it away.
Thanks very much, Mark, and good morning, everyone. So I'm Chris Noone, CEO of Carly Holdings Limited. Just go through our disclaimer slide and we'll get straight into it. So Carly Holdings is operating in the mobility market in Australia. We are Australia's first flexible car subscription service. A car subscription is an alternative to purchasing, financing, or leasing a vehicle. And the key attribute that it offers is flexibility to both individual consumers and also businesses as well. We launched car subscription in 2019 and immediately picked up very large shareholders: SG Fleet, the largest fleet management and leasing company in Australia, and also Turners Automotive, the largest seller of cars in New Zealand. And the CEO of both those ASX listed companies also sit on our board. We know that there is a large opportunity for car subscription in Australia. We've seen that with our own growth. We've also done our own research in the market, and we've also seen what's happening with other businesses overseas. So we have 10 years experience in the mobility industry, coming in from an adjacent business. We pivoted away from that business in 2019 and closed it down entirely last month. So we are now 100% focused on the car subscription opportunity. The reason we pivoted away from the rental business is that subscription is a growing market that does not have any incumbent players, and it sits very nicely between rental and long-term purchase of vehicles. So we've been able to establish quite a large niche for ourselves where there are very few competitors. We have quite a unique way that we approach the opportunity. We have two different ways that we source vehicles. We have what we call our direct fleet, which is a fleet that we own or finance. We also partner with leading automotive manufacturers, dealer groups, and also fleet management companies to monetize their vehicles on an asset-light basis. We do not pay to buy those vehicles. We just pay a daily rate to use those vehicles for every day that they're subscribed. If we no longer need the car, we hand it back, and there's no impact on our balance sheet for those vehicles. We've been growing very strongly. Our latest results for the half year saw a 69% increase in revenue and a 261% increase in gross profit, and we've been doing that consistently. So let's look at a car subscription. There are many different variations and flavors of car subscription in the market. We think we have the most pure and honest and transparent offer in the market. For us, it is a 30-day minimum commitment and 30 days notice to cancel. It includes registration, insurance, maintenance, and roadside assistance. All the customer pays for is fuel and tolls. It is your own car to use, park in your driveway, park in the car park at work, drive wherever and whenever you want. So car subscription is not car share. Car share is 1 hour to 1 day. It is very expensive. Car rental is a very traditional industry with incumbent players, very high customer acquisition costs. Car rental is typically 1 to 14 days. Car subscription is minimum 30 days, and we have customers who keep a subscription vehicle for up to 2 years. Our average subscription period is 5.4 months. And we're not a long-term finance or purchase or leasing, which starts at 2 or 3 years. So our product is for people who would normally purchase or lease a vehicle, but because they need flexibility, their needs for a car may change, their lifestyle may change, their business needs may change, therefore car subscription is suitable for them. So looking at our recent results, we've just released our half-yearly results on Monday. We saw a 69% increase in revenue, 261% increase in gross profit, and we reduced our net cash used by 45%. One of the drivers for that was an 80% decrease in marketing cost. And we're growing our fleet of vehicles. In recent months, we've secured $3.2 million of asset financing. And as of today, that's all been fully deployed to purchase vehicles. We're consistently maintaining an 87% vehicle utilization, and we're growing our fleet quite quickly. We grew the size of our owned and financed fleet by 158% in the last 12 months. So just drilling down a little bit into that revenue growth, we launched just before COVID. So we've tested our model and been challenged by COVID and come out of it a much stronger business. We continue to grow our transaction value all the way through COVID. This is our main exposure is on the East Coast, where many people were locked down for months and an end. Despite people being in lockdowns, we were subscribing more and more vehicles every month, and we continue to grow during those difficult times. And we've accelerated that growth as we've come out of COVID. What's more interesting is that our revenue is increasing at a faster rate than transaction value. This is because we own more of the vehicles in our fleet, and therefore we retain more of the revenue from those vehicles in the business rather than paying to third-party owners. And that high percent of transaction value will continue to increase as we increase the size of our owned and financed fleet. So drilling down into that a little bit further, looking at the 5.4 months average retention period, our transaction value equates to a lifetime value on average of just under $6,000, and that is continuing to grow. The revenue is around $3,680, and that grew 32% in the last 12 months. Gross profit around $1,200, and that grew by 16%. And as I said before, we believe we can continue growth in all of those figures by growing retention period, keeping more revenue within the business through our owned vehicles, and also having a laser focus on costs. At the same time, we've also reduced our customer acquisition costs so that we're acquiring customers much more cost effectively now. And looking at that from a half yearly point of view, as I said, COVID were challenging times, but we still had good revenue. But we've really taken off post-COVID as the economy has opened up, and also as we've brought on more and more vehicles that we own in the business. And when we own the vehicles, we can choose the exact type of car, we can choose the price point, we can choose the location. So we are buying cars that are in high demand from both our retail and business customers. Our focus for FY23 is pretty simple. We are on a path to profitability. That profitability is the way we get there is by growing our vehicle fleet. We've secured over $3.2 million in asset finance so far, and we're in advanced negotiations for further facilities. We've shown that when we do get finance, we can capitalize on that finance and generate revenue very quickly. We're increasing revenue overall from both the retail and also business markets, and we're decreasing our customer acquisition costs as we scale. So as we scale, we don't want to have massive marketing budgets. We want marketing to be one of our smaller cost lines, because we don't need to compete with big incumbents. We don't need to compete with the big rental companies. We don't need to compete with the big leasing companies. We are an alternative to those products, and we fit within a piece of the market that those companies are not playing in. We also see a massive opportunity in the electric vehicle market. This week, we've received 4 of the Ioniq 5 vehicles from Hyundai. Now, these vehicles sold out online in one day. You cannot buy these vehicles at retail. However, due to our strong relationship with Hyundai, they've provided those vehicles to us on an asset-light basis. We have not paid 1 cent for those vehicles. We just pay a daily rate for each day that those vehicles are subscribed to our customers. 50% of those vehicles are already on the road after a couple of days. So looking a little bit more closely at what we do as a business, Carly is an online marketplace. We sit between the customer demand and the supply of vehicles. On the demand side, we have consumer market and also business, government, and not-for-profit. On the vehicle side, we have 2 different ways that we put cars into our fleet. We have the owned fleet, where we purchase, lease, or finance vehicles. And our preference is to finance vehicles to get leverage from our available capital. Where we've come from as a business is our roots were as an asset-light business. We never owned or financed the vehicles. So our third-party fleet still makes up a fairly sizable proportion of our fleet. And these vehicles are provided by automotive manufacturers, dealers. We get ex-lease vehicles from fleet management companies and also strategic partners as well. So we're agnostic as to where we get a car from. We want the best cars at the best price as quickly as possible in the best locations. So we're the only company in the industry that works on both that asset-light and asset-heavy basis. As a business, we do all the things that the owners of vehicles cannot do. We do the marketing, we provide the website, we collect the recurring subscription payments from the customers. We do the ID verification, which is very important in this business. We want to make sure that we're putting very high quality customers in cars who pay their subscription fees on time and return the cars in good condition. We provide all the customer service, we manage the fleet, we provide the insurance for the vehicles, and we do all the data analysis. So looking at automotive manufacturers, a lot of them are starting to play in the subscription industry, but they don't know what to do. They partner with companies like Carly to enter that market. The same thing with automotive dealers. They are interested in developing recurring revenue streams for their vehicles, so they partner with Carly to access those monetization opportunities. And for ex-lease vehicles, we provide an opportunity for lease companies to receive a second income stream, a second life for vehicles that they may have already put out for a period of time on a lease. We monetize those vehicles for a year or more, then hand them back to those leasing companies, and they can then put them through the auction channel. So looking into our customer segments a little bit more, we have a very strong understanding of the sort of demographics of customers who would take on our vehicles. We know what the age groups are and what their personal circumstances are, but what's more important are the use cases for which people would use subscription. Subscription is not something that someone would do for 20 or 30 years. Subscription is perfect for individual businesses who value flexibility. It's for when our customers are typically customers who would normally buy or finance a vehicle, but because their needs will change shortly or further into the future, taking a subscription vehicle is the most economically wise decision they could take. So it could be that they want to trial an electric vehicle. It could be that they're on a short-term contract for a job, and after that contract, they no longer need a car. They could be a visa holder who cannot get finance for a car. They could be in probation period for a new job, or their car needs could change throughout the year. And that flexibility also carries over to business, government, and not-for-profit as well. They could have a short-term project or budget. They could be experiencing delays in purchasing new vehicles. They could have employees on short-term contracts or secondment or in probation periods. They could be scaling up sales teams in certain times of the year, and they don't need those sales teams at other times of the year. They could have seasonal projects as well. So there's lots of different reasons that any of our customers would use subscription. And we like to think that anyone in Australia of driving age could be our customer at some point in their life. So going into that a little bit further, we've done research with Omnipol to look at the propensity of customers to be interested in car subscription. And understandably, it is higher interest at the younger age groups. If we're looking at Gen Z, 69% of Gen Z is interested in car subscription. But the great thing about that is most of that cohort have not yet turned 21. So every year, a large group of people are turning 21 and are coming into our target market. So Gen Z only makes up a very small proportion of our business at the moment. But as that generation matures and reaches driving age, we have a very strong flow of customers coming into our potential customer pool. Where we are strongest at the moment is with Gen X. They're making up 40% of our current demand. And we also still have reasonable demand at the older age groups as well. So this is not just a proposition for the younger generation. It's a proposition that makes sense to anyone who values flexibility. We're also smart about how we grow our fleet. I mentioned that we have an asset-heavy fleet where we own the vehicles, and also an asset-light fleet where the other parties own the vehicles. Prior to COVID, asset-light worked very well for us. When COVID hit, supply of vehicles became a lot more restricted and vehicles became more expensive. So we then started buying and financing our own vehicles. As supply of vehicles returns to normal, which it will, we believe that the asset-light opportunities will continue to grow. And that's where we have big opportunities to work with the likes of Hyundai, Subaru, Peugeot, SG Fleet, Oryx, Custom Fleet that we can work with now and have worked with in the past. So we have two different ways that we can grow our fleet, and we will take vehicles which provide the best value to our business. Now, this is probably the most important slide in this presentation. What we're doing here is showing the value of asset finance to the vehicle, to the business, and what we've been able to achieve when we have secured asset finance. Asset finance is the key to our path to profitability. In this example, in the yellow box, we've taken an asset finance facility that we secured in July 2022. It was a $1.5 million facility. With that, we were able to purchase 64 cars, and we were able to secure delivery of all of those vehicles by December 2022, so a 6-month period. We were fairly slow in getting delivery of those vehicles because we were starting cold. We had no forward orders in the market when we received that finance. But even given that slow delivery of cars over the 6-month period, we generated $119,000 of revenue. In the second 6 months, because we have all of those 64 cars for a whole 6-month period, We predict we will generate $335,000 at an 87% utilization rate, which is consistently what we achieve. On a 4-year basis, that would equate to $670,000. If we then look at what other asset finance facilities could deliver for us, the orange box there is an example based on that real life case study. Looking at a $10 million asset finance facility, looking at the same phasing of the delivery of vehicles over the first 6 months, we could generate $796,000 in revenue, increasing to $2.23 million in the second 6 months. And the first full year of full monetization can generate $4.46 million on a consistent basis year after year. So we can see there that asset finance can help us to grow our revenue quite substantially, and a major focus for our business is in securing that next asset finance facility so we can supercharge our growth. So Carly's not the only player in the car subscription market. We do have some other competitors in Australia. We are the one that is the most focused purely on the car subscription opportunity and the only ASX listed company focused on car subscription. Overseas, there are some very large players, especially in Europe and to a lesser extent in the US. It's important to see the amount of equity that these companies have been able to raise, but also the importance of debt funding for them to grow their vehicle fleets. So we're watching these companies very closely to see what moves they're taking and to see how we can accelerate our growth as well. We see that there's a massive opportunity for electric vehicles and car subscription. Car subscription is the perfect try before you buy opportunity for electric vehicles. Taking an electric vehicle for a 20-minute test drive doesn't help you understand how it's going to work in real life situations. Taking the vehicle for a month or 2 or 3 really lets you understand how charging works, how commuting works, how charging at work can work, how it works on holidays. So we see a big opportunity for Carly to be able to support that transition to electric vehicles, and we see that as a very large proportion of our fleet going forward. We've also been very fortunate through our relationship with Hyundai to receive the Ioniq 5 electric vehicle. Now, this sold out in 1 day. You can only purchase this vehicle online, and it's no longer available. We were able to secure 4 of these vehicles on an asset-light basis, and we've already put 50% of those vehicles on the road in the first week. We've also been a successful applicant with the New South Wales government with the EV fleet incentive, which will provide us subsidies to allow us to purchase electric vehicles as well. I'll just go briefly into some of our important strategic relationships. SG Fleet is our second largest shareholder, and their CEO sits on our board. SG Fleet is the largest player in the fleet management and leasing business in Australia, and they count a number of the largest corporates and federal and state government departments as their customers. We receive vehicles from SG Fleet on an asset-light basis where they retain ownership of those vehicles and we monetize on their behalf. And also we lease vehicles from SG Fleet on an arm's length basis. We also receive referrals from SG Fleet for business and government customers, and some of our largest corporate customers are direct referrals from SG Fleet. As we grow our fleet of vehicles, there's a lot of scale for us to grow that relationship. Turners Automotive is the largest seller of cars in New Zealand, and we have provided the software platform to allow them to launch Turners subscription in New Zealand. This business grew at 136% in the last 6 months, and Turners are putting a lot of effort into this business, and this is a very important licensing revenue stream for Carly. Hyundai has been our partner for a number of years. We have a very strong relationship with them. They provide vehicles into our fleet to be monetized. We also provide the opportunity for Hyundai to feed their certified used car program by taking new cars in providing them as subscription vehicles, and then delivering them back to Hyundai as good quality used cars at the rate they need them, at the time they need them, at the kilometre thresholds they need them as well. And there's a great opportunity for us to expand our relationship with Hyundai as the supply of vehicles returns to normality. We also place a big emphasis on bringing in high quality customers into our business. So we've developed our own fraud prevention platform called PeerPass. We do ID checks, we do credit checks. We have other technology to look for potential fraud with potential customers as well. And this platform has been very effective for us to improve our conversion rates, but also to reduce our bad debt down to very low levels and to achieve above average returns on our insurance policy. In most years, we profit share with the insurance company because we deliver such a low claims loss experience. We're also the only car subscription company to have an ATO product ruling. This is exclusive to Carly, and any person or company that subscribes to one of our competitors' vehicles cannot rely on this product ruling because it has been exclusively developed to work with our business model and our terms and conditions. And this is a very important advantage for us moving into the business market. So we have a number of competitive advantages, which I've gone through. Just very briefly, touching on our board, Robbie Blau is the CEO of SG Fleet, listed on the ASX. Todd Hunter is the CEO of Turners Automotive, also listed on the ASX as well. We also appointed a new CFO last year, Mike Mobilia. Mike has a very strong background in asset finance, and he's leading our negotiations for the securing of materially larger asset finance facilities, which we've identified as the quickest path to profitability for the business. So that's where I'll leave it there. In summary, we have a very strong understanding of how to grow our business. We've proven all the aspects of our business. There's very little blue sky or what do we think will happen here. We've proven every part of our business. The opportunity for us now is to secure asset finance and continue the growth that we've seen in the last few years. So thank you very much for your attention today. If you'd like to get further information, you can check out the Carly Holdings investor website. You can send me an email on that email address, and you can also sign up to our investor newsletter.
Thanks, Chris. I might just kick off with a couple of questions. The first one is on the direct side of the business, as I'm sure Robbie Blau will tell you, managing residual value risk, as it pertains to the model of, how do we maximize the profit for every car that we buy? Can you maybe just talk a little about, fleet renewal, residual value risk, as your kind of direct fleet gets to that point of, okay, we need to get these out and new ones in, and how you manage that kind of risk, because it's probably not too prevalent right now, but if we look out, 1 to 3 years from now, it'll probably be more of a factor in the operating model.
We're certainly very aware of that, and we've been conservative within our forecasting. The first thing to do there is buy good quality cars. We're buying in-demand vehicles with 5 or 7 year warranties. We're not buying the cheap and cheerful cars. We're buying cars that we know will have good resale value. Through our relationship with SG Fleet as well, we have good understanding of the future market value of vehicles. So we're being guided by their experience in what are the best vehicles to buy. We look to own these vehicles for up to 4 years because a subscription customer puts very few kilometers on the vehicle. There's not a lot of wear and tear. Compared to the rental industry where there is a lot of wear and tear on the vehicles, we can actually keep those vehicles for longer, monetize them for longer. And even though the value of the vehicle could depreciate over time, we can take the vehicle down through different price points, so it's still in high demand all the way through the ownership of the vehicle. So we are conscious of that residual value risk, but we also do have very good data, coming in through our partners, and are being quite conservative with the types of vehicles that we're buying. At the moment, we're focusing on small to medium SUVs under $30,000. This is where the most popular vehicles. We're not focusing on luxury or European vehicles. We can get quite a few of those vehicles through our asset light partners, but we bear no residual risk for those vehicles.
And a question from the audience. What are the common issues that lenders cite when seeking asset finance? So I guess, what is the risk lens that they're applying to giving financing to Carly? What's the kind of main concern for them?
One of the things they look at is utilization, and we actually score quite well on that. The key number that all of our business is focused on through sales, marketing, operations, finance is the utilization number. It's no point us having a large fleet of cars if they're not generating revenue for us. So we work very hard on a daily basis, and we have a very strong cadence of meetings and communication in the business all throughout the week to ensure that we've got the latest information on utilization across all of our locations across Australia. And we dial up and dial down our marketing accordingly to make sure we get those vehicles on the road as quickly as possible. The other things that the financiers are looking for, they're looking at the experience of the management team and the board. This is a relatively new market in car subscription. It's not as old and traditional and understood as car rental and car leasing, for example. But they're also looking at the strength of the management team and the board of directors in having experience in the automotive industry, but also in new product development and innovation as well, because they don't want just old school thinking here. They want innovation, but they also want the comfort that does come from our ASX listing and the fact that we're audited, but the comfort from also understanding the more traditional automotive industry as well.
And then I know we're a little over time, Chris, but if you have got time, I just want to squeeze in one more question. The 5.4 months, where are my notes here? 5.4 months. Can you give us a sense of how that's been trending? If we take a rolling 12-month basis, has it been fairly consistent? Or, has it been increasing slightly, decreasing slightly? Where is that, as the data set has got bigger, what's been the trend in that?
So we look at this on a 12-month cohort. So it's a very accurate way of recording the retention period. And it doesn't move quickly over time because we are looking at that such large group of people. What we found through COVID, and it started to increase quite substantially as our customer base grew and customers stayed with us for longer. We have seen a slight drop in retention period from 5.7 months down to 5.3 months over the last 9 months or so. And that's been as a consequence of us retiring some of our older asset-light vehicles. And we, at certain points of those retirements, we weren't able to match those one for one with new vehicles coming in on the asset-heavy side of the market. So we've now gone through that, where all of the asset-light vehicles that were reaching their age have all been retired. And we're now making net additions to not only our finance fleet, but the overall size of the fleet. So we see that retention period will now start to increase again.
Very perfect. Chris, we've gone slightly over time, and I want to be respectful of your time and everybody else's. So we'll leave it there. And yeah, if anybody's got any questions for Chris, you can give him an email there, shareholder Carly. And I do believe, Chris, if I saw it somewhere, Finola and the RAS team initiated coverage on you just before Christmas, or was it just after Christmas? I can't remember when.
It was just before Christmas, and the update report came out this morning. So that will be available from the Carly investor website, but also from the RAS website, and also been sharing it on LinkedIn this morning.
Okay, brilliant. Perfect. Thanks everyone. And just a reminder, we've got another event happening tomorrow morning. We've actually got 4 presenters tomorrow morning. So hopefully some of you will be able to join us then. And thanks again to Chris for coming back in and giving us an update on all things Carly Holdings.